Hello and welcome to our latest Insider interview. I'm Caldwell, and today I'm joined by Job Curtis, who is Fund Manager of the City of London Investment Trust. Job, great to see you again.
Very good to see you.
So Job, many of our viewers will be familiar with how City of London invests, but for those that are not in the know, could you explain how you approach investing in the UK dividend market?
Yes, well, we're seeking to be invested in companies which have got good prospects for growing their profits and dividends, and where it's kind of the valuation is reasonable, it's not overvalued. And so we're looking for companies, we're looking to avoid companies which are expensive or which may superficially be paying good dividend yields but have got poor prospects and not investing enough for the future and may end up cutting their dividends. The other side of our style is we're quite conservative. We believe in companies with strong balance sheets and good cash generation. Those sort of companies are best able to both grow their dividends and also invest in enough for the future, for future profits growth and sales growth.
So City of London is a dividend hero. You've increased income payouts every year since 1966. Now, while the men's football team did not bring it home this summer, so therefore the wait goes on for another major trophy, has City of London brought home another year of dividend increases?
Yes, I'm pleased to say we have. Our financial year ends in June, and we've declared our fourth interim dividend of the four. And so the total dividend this year went up by 2.5%. So we have increased our dividend again, and we have got the longest track record of any investment trust, as you say, going back to 1966 of annual dividend increase. We are helped by the investment trust structure, which means in the good years for dividends, we can hold back a bit and build up a reserve, which we use in poor years, like in 2020 during the pandemic, when there were a lot of dividend cuts from companies, and we were able to carry on growing our dividend for our shareholders.
And the yield on the trust, it's around about 5%.
Yes, it's just slightly under 5 now, but it's approaching that, yes.
You're an active investor. You're not afraid to make changes. Since I last interviewed you, which was last summer, you've bought a new position in Burberry. So could you talk us through that?
Yes, but it's a very small investment we've made, and obviously we've been a bit early, but when we bought into Burberry, the shares were already 40% from their 12-month high down, and that's reflecting a very tough environment for companies making luxury goods at the moment, particularly with the slowdown in China. But having said that, Burberry is a very long-standing British company. It's been around for many decades. I think they've made some mistakes trying to go a bit too upmarket, but their kind of core business of making the raincoats is a very long-standing one. It's a very small holding for us at the moment. It's our third smallest, I think, as the day I'm talking. So I'm just sort of watching it. We've been a bit early with the investment, but I think ultimately Burberry will recover. But it's probably a bit too early to add to it further from my perspective.
And could you run through other portfolio activity? Could you name some of the shares that you've been buying or increasing exposure to?
Yes, we think there's a lot of value in UK financials, and we've bought a new position in Aviva, which owns companies like Commercial Union and Norwich Union, General Accident. It's actually the largest insurer in the UK in general insurance, such as motor, household, that type of thing. And it's also got a big life assurance arm and big in workplace pensions. It's also number 2 in general insurance in Canada, and it's got a attractive dividend yield. It's also buying back its shares, so it's kind of growing its dividend, it's decent dividend yield around 6%, and also buying back its shares. So we think it's an attractive combination. One area we like at the moment are the banks, and we've added significantly to our holding in NatWest, which where we think profits are going to be better than markets been expecting, and they're going to hold up because of the way that the banks can reinvest balances, which they'd previously hedged at very low interest rates. As these hedges mature, they can lock into higher rates, and so that's a key factor for us. Inchcape, which is a motor distributor, it's got a long history, but originally did various other things, but it's now focused on distributing cars, not so much the retailing, it's more the kind of in various countries getting the cars from the ports to the showrooms and helping the motor manufacturers market the cars, and that is they got very long relationships with some of the big car equipment makers. So those are a flavour of what I've been up to, 3 different situations.
And which companies have you been trimming or have exited the portfolio?
Well, one was Wincanton, which got taken over. There's been a lot of takeover activity in UK markets, an indication of what good value the UK is. And this is a logistics company. It was originally bid for by a French private company, and then an American company put in another bid, and we got a very good premium in the end. And so that was sold. But on the other hand, some of the overseas listed holdings, we're allowed to hold up to 20% overseas. And with the UK looking so much cheaper, I have taken some profits in that area. I mean, to mention Siemens, which is a big German industrial conglomerate, good company, but got a fair amount of exposure to China, which I meant, there is a bit of a slowdown, and we actually sold that one quite well ahead of a downgrade of their profit expectations. And Holcim, which is a building materials company headquartered in Switzerland, but very global, and they announced that they would spin out their American operations on the American, split into 2, and that's caused a big gain in the share price. And because obviously by doing that, they get advantage of the much more highly valued US market, and that's now been reflected in our view in the Holcim share price. So we took a decent profit in Holcim as well.
As you mainly invest in FTSE 100 companies, investors are being given a lot of global exposure. Could you name the types of sectors that are standing out for you at the moment in terms of their valuations? You've touched on banks. Is that the standout valuation sector?
Yes, I mean, our biggest sort of area now in the fund is financials. So that's banks and insurers, and also the kind of financial services. And we think there's a lot of value in some of these UK stocks in that area. And we're now actually overweight. That's got a bit more in the banks than the market average for the first time in over 20 years. That's a signal of our kind of confidence. And this is an area where we think the valuations of the UK banks are still quite cheap relative to what you can find overseas, and yet they're coming out with very good profitability. So we like the banks, and we think there's a lot of, I mentioned Aviva and life insurance, but also a lot of value in companies like M&G, Legal & General as well, from a dividend perspective. So that's probably the biggest single weighting in the portfolio is kind of financials, general mixture of banks, insurance and financial services is our biggest weighting at the moment.
And in terms of the banks, do you own all 5 of the UK listed banks?
We don't own Standard & Chartered, so we're our kind of big weightings relative to the index are in NatWest, Lloyds and Barclays, which are kind of the UK domestic ones. We've also got a big holding in HSBC, but it's such a big stock, we're actually technically underweight relative to the index, and there it is a kind of 4% position. But it's we like HSBC, but obviously it has got, it's got most of its business in Asia Pacific. It's got obviously quite a close link to what's going on in Hong Kong and China. So that would kind of prevent us from being overweight in HSBC. But we've still got a decent holding, and it's been very good for dividends of late.
You have exposure to defence companies and tobacco firms. Now, some investors will rule out those sectors on ethical grounds. So could you make the case for the reasons why you're investing in those 2 sectors?
Yeah, I have to say I do struggle a bit why defence companies should be excluded on ethical grounds. I think there's been a bit of a rethink on that since the Ukraine war broke out. But if you don't have companies making good weapons, we're going to be defenseless against people like Putin today, or going back in history, if we didn't have Spitfires in 1940, we'd probably got invaders. So I think there are some people who just don't believe in it on religious grounds, say. But I think overall it's a practical effect that when you've got aggressive countries out there, that you need companies to make good equipment. And BAE Systems is one of our biggest holdings in the City of London. It's an excellent company. It's obviously our main defence contractor in the UK, but it's also the 5th biggest in the United States, which is a massive achievement. And they're winning huge orders in Eastern Europe, Australia, Japan. They're kind of a very global company. So that's a really good company. Tobacco is different. Tobacco, when we look at these controversial issues, it's a question of how much it's reflected in the valuations, and the tobacco stocks are very cheaply rated because a lot of people won't own them, which means they're on very high yields, yet these businesses do convert profits into cash at a very high level. They're very cash generative. So within our portfolio holding, we have two British American Tobacco and Imperial Brands. Holding them helps us. They got very high yields, and that helps us kind of own lower yielding shares, which we've also got. We wouldn't be able to own so much lower yielding ones if we didn't have these kind of safe, heavy yielders at the other end. And both companies, we do engage with companies. That's if you own shares in a company, then you can engage with companies. And in particular, BAT's got quite a huge program to move to less harmful products and cigarettes, and they're making great strides in that. So so they are changing, but they are pretty useful helping us pay our dividends.
I wanted to next turn to performance. So in share price total return terms, over the past decade, City of London, it has slightly lagged the FTSE All Share Index. So could you talk us through the reasons why?
I think actually, if I've looked at the figures at the end of June, because you obviously gave me a bit of questions in advance, and our NAV total, our net asset value return is actually ahead of the index over that 10-year period. I mean, the share price total return might have dipped slightly below, and I think that's because we have been we for a long period our shares were on a 2% premium to NAV, and at the end of June they were on a roughly 2% discount. So I think that may be a factor, but certainly in terms of the NAV total return performance, the most recent month-end figures, which ended June, and consistently before that, we've always been ahead of the index over 10 years. And actually the share rating, as the day we're talking, has recovered quite well, and we're back on a small premium as of the day we're talking today.
And of course, the NAV return, the net asset value return, that's the performance of the underlying investments.
Yes.
So that's what you can control.
Yes, exactly.
Whereas the share price, it can fluctuate due to supply and demand.
Yes, that's absolutely right. But we do with the share price, when we've issued a lot of shares over the years on a 2% premium to stop the premium going too high. And similarly, when we moved we've been on a discount of between 2 and 3%. So kind of during the period from kind of March through to the end of June, we were buying in shares on a kind of premium, a discount of kind of 2 to 3%. So we were trying to mirror the so that hopefully dampens down the share price volatility that investors might otherwise face.
Job, thank you very much for your time today.
Pleasure.
So that's it for our latest Insider interview. Hope you've enjoyed it. Please let us know what you think. You can comment, like, and do hit that subscribe button. And hopefully, I'll see you again next time.